Hi everyone, it's Alex here at Cestrian Capital Research. We have a very special webinar today. We have a special guest, Alan Longbourn, who I've asked to come and talk to us. I'm going to introduce Alan and his work in a moment. But just very briefly, we're going to do the disclaimer in a moment. Alan's come to talk to us about the impact of liquidity flows on global risk asset prices. This is a lens through which one can look at securities, which was a huge eye-opener for me, one of a small handful of aha moments after I finished my institutional career and started investing my own capital. So as you know, because I've said it many times, my background personally is in venture capital and leverage buyout. So I came to public securities with a pure fundamentalist background, had to teach myself technical analysis, the impact of options on equities, those sorts of things. And then I started reading Alan's work on liquidity, and he's going to explain what he means by that, and the way that that flows into risk asset prices. And the first time I read it, I was like, no, that can't be. And then the second time I read it, I was like, oh, okay, this is a fabulous backdrop for understanding the ebbs and flows of markets. Not every day, but over the course of months and quarters and years. It's a really terrific lens to understand. I'm going to ask Alan to explain that. Alan's going to go first. After he's done, we'll see how much time we have left. We'll run on our normal open mic basis. So if you have questions, comments, things you agree with, disagree with, want to dig into further, I'll ask you to open the mic and just shout. If you type questions into the webinar platform here, I can read them out for Alan to respond. And if there's time at the end, we'll go over our usual market review. So we'll do the S&P and the NASDAQ, I'll do bonds and the VIX in particular. And then if we've got time, we'll look at some other stuff. Okay, before we do any of that, let's do our disclaimer, which is on your screen now. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in the webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Cestrian Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the author as of the webinar's date of broadcast and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Cestrian Capital Research. Cestrian Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, I'm going to hand over to Alan now, and I'm going to ask him to share a few slides and also, first of all, to introduce himself and his background and how he got to do what he's doing. So Alan, I'm going to hand you the screen right now.
Hello, that's Alan Longbourn here. I'm come to talk about aggregate liquidity in markets. We go to the, can we put those slides list back on?
Yeah, I can I'll flip them. Yeah, hold on.
Actually, I can pull them up and present it.
That's okay.
And we'll put on.
Okay, yep, which one do you want?
Put on slide number 8.
Sectoral balance.
That's right. Sectoral balance. Okay. Now this is something that I do on a monthly basis as the data comes out. You can see on the table here.
Hey, Alan, just do me a favor. Just introduce yourself for everyone's benefit. You're very modest, but just walk everyone through, what you do.
Hi, my name's Alan Longbourn. I'm my base training education was a degree in town planning, and then I went on to do other qualifications in business, ending with a master's in business administration. I basically am a real estate developer and currently developing real estate in the southwest of Western Australia. And of course, I trade my own account, being stocks and bonds and so on. And I'm also an author on Seeking Alpha, and I write a regular column on the Seeking Alpha. And I'm also a guest author at 2 Seeking Alpha investor services, being prescriptive analytic models and Away from the Herd. And the reason that I'm there is because these 2 services share my investment perspective, which is looking at the fiscal flows in the economy and their impact on risk asset prices. And as far as I'm aware, and I have looked at other investment groups on the Seeking Alpha platform, where I've been an author for the last 15 years or so, They're the only two services that do the same sort of thing that I do. Everybody else that I've read articles about and looked at use fundamental analysis, mainstream economics. They believe myths such as that government debt is a bad thing and that one day it's going to swallow up the governments and sink the world, all this sort of nonsense. And as soon as I read that, I'm able to write these people off. And the only two services where that doesn't happen are the ones that I just mentioned. And that's the core theme here, is that when the government spends money, and we're talking about the federal government, it puts financial assets into the private sector and causes financial balances in the private sector to grow. When the government taxes money out of the private sector, or with charges and fees, or it sells something, it basically removes money from the private sector, it reduces financial balances, and it's a mathematical thermodynamic result that financial balances and risk asset prices in the private sector must go down if the government's reduced the amount of money flowing in the economy with the taxation, with this extraction. And that's the key fundamental investment approach. So as long as what Robert Ballon and I call systemic liquidity is rising, in theory, risk assets must also rise. It's never in a straight line, but generally they will rise at the macro level over time. And that's what
I'm going to interrupt this, Alex. So do me a favour, okay? When all of us hear the word liquidity, we all hear the same word, but we all think it means something different. So when you say it in this context, could you define it for us?
Yes, the slide that's on the screen, US sectoral balance table, yeah?
Yep.
What that is, you see it across the top row, G plus C plus X. G is this is on a monthly basis. G is the government deficit, federal government deficit, which is the creator of the currency, okay?
Yeah.
That's how much money they put net into the economy. Mostly it's green and sometimes it's red. And red means it's what they call a government surplus, where they've extracted money with taxes and charges.
Okay.
C is bank credit. Banks can also create money and put it into circulation. And that is also mostly green. And you also get times when it's red, where when you net it out, there have been more loan repayments or debt write-offs than there was credit creation, and it leads to an extraction of money from the economy. And then there's X. Now X is the rest of the world, and that is always red because of America's, and this table is for America. That's because there's always a net flow of money out of domestic American bank accounts into foreign held bank accounts at the Federal Reserve Bank at the macro level, and that's why it's always red. Now, when we add
trade deficit, is it?
Yeah, when we add those flows together, and that's the row marked P equals G plus C plus X, you get a net figure of how much system liquidity is growing or sinking each month. And if we go to, if we go to chart number 12.
Yep.
Yeah, that's that information shown in graphical form.
So walk us through this chart. Anyone here that's a member of PAM will recognize these charts, but for anyone that isn't, can you walk us through this?
What this is, what's most important on this line is the blue line. The blue line is the addition of those of G plus C plus X on that table. And it's expressed in a change rate format, so you've got a zero line running. And what we're interested in are peaks and troughs and the general trend. And up until now, up until recently, I should say, 2020 with the COVID crisis, it was a pretty steady heartbeat, probably with a trend. You can see a generally trend from 1980 to 2020 downwards.
Yeah.
And then we had COVID and the COVID spending and support, and then you can see a massive jump upwards in the blue line. And then, because this is thermodynamics, after a short period of time, say 5 years, we had a big run downwards. It's a mirror image. What goes up must come down in thermodynamics, like when you throw a rock into a pool of water in wave motion theory and frequency and so on. And what this gives you is a sense of market direction. Now, if you go to chart number 14, have you got that up?
Yep.
Yeah, okay. Chart number 14, the brown line is the critical one. The other ones are, the brown line is the leading factor. The other ones, as you can see from the legend, are various risk assets and GDP and that sort of thing. What this is showing is the brown line is the addition of the gross fiscal spending from the big 5 economies in the world. And when you add those all together, you get a massive amount of spending. And this gives you what we call in thermodynamics a carrier wave upon which all other waves are based. And that brown wave shows you that we've got rising fiscal expenditures into and peaking. They've actually peaked and they're sinking for the first quarter of this year. And then they rise again into the second quarter and probably into the end of the year as well. So we know that systemic liquidity, as we define it, which is all that money that's been created by federal governments and the banking sector, is rising. And that's what we do. We add it together and we chart it. And one of the things that Robert Ballon has done and shown me that I learned from his articles before we joined forces is he charts all these different factors on a time scale. And then what he does, he moves the lines backwards and forwards and lines up the major peaks and troughs. And you can determine from doing that the leads and lags of things on each other. And we worked out that fiscal expenditures at this level lead markets by about 5 to 6 quarters. And you can pull that line forward and you can see where some of the other lines finish well before the end of the brown line. For example, the S&P composite finishes 1, 2, 3, 4, almost 5 quarters. So you can roughly guess where the S&P composite's going to go from the direction of the brown line.
So just to stay on this slide, Alan, this would suggest that if fiscal spending slows up, then over the course of the next several quarters, you could expect the S&P to start to fall. Is that reasonable?
Yeah, it's sinking. We're in the first quarter of 25 now.
Yeah. So that's here.
So that's right. So probably about, well, the beginning of the second quarter, which will be April, I believe, the market should rise. And for my own book that I trade at the moment, I'm net long, but I've stopped deploying capital and I'm waiting for April. And when April comes, then I'll start deploying my capital, because that's when the net macro flows at the world level and also in the US start to rise again. And that's that smaller peak. It's almost like a head and shoulders pattern. That's when, that's my signal to start deploying capital. Now, all sorts of things are going to happen in the news during that time, which will influence its direction. But broadly speaking, this is the spine that runs through the markets and cause them to rise and fall at the macro level, and gives you something upon which to base your timing.
So let me ask you this, Alan. Conventional wisdom, as you say, is debt is bad, right? And government debt is bad. Okay, so let me just run through this. Conventional wisdom goes this: Government debt is bad. Why? Because it leads to increasing interest payments, increasing principal redemption payments. That's money that has to be removed from the economy one way or the other, either by tax take or by endless refinancing on ever more punitive terms. And therefore, government debt is it's an absorber of value in the same way that if you are highly levered personally and you're paying 24% credit card interest, you're just taking money out of your own pocket that could be spent on something useful instead. So conventional wisdom says government debt bad. However, in this theory, let me see if I can simplify it. And this is how I sort of explain it to myself. And you shoot me down if this is incorrect, and see if you can come up with an alternative. This is the way I think this model goes. Government debt is not like private sector debt. Why isn't it like private sector debt? Because governments create money. Money is a concept created by government, central banks, and to a lesser degree, private sector banks. Okay. When debt is issued, credit is created. That credit becomes money. And insofar as money enters the economy, the private sector economy, it's it's money that has been created by government and placed in the economy by government. Now, that money comes into the private sector economy. Some of it is used to buy food for poor people and shelter for poor people, but most of it ends up as a surplus, which is to say an earning surplus for companies or individuals, or a current account surplus for companies and individuals. And that surplus, one way or another, finds its way into risk assets. They could be bonds, they could be stocks, they could be cryptocurrency, but into risk assets because that's what people in the aggregate do with surplus. They put it into risk assets of one kind or another, real estate, stocks, bonds, whatever it is. And therefore, in this model, the creation of government debt leads to the creation of money, leads to the creation of a private sector surplus, leads to a flow of funds into risk assets, more demand for risk asset prices up. Is that a reasonable simplification, or have I misunderstood?
No, that's a very good explanation. If you go
Okay.
to slide 16, there's a famous.
I'm going to interrupt Alan here. Okay,
Sure.
something Alan wrote. He's probably written it a lot, but I saw it a couple of months ago, and he said government sector deficit equals private sector surplus equals rising risk assets, and that's the simplest explanation I've seen for this. And that for me was a huge light bulb moment, and I think this is what Alan's about to explain.
Absolutely. This chart shows it's a butterfly pattern, and on one side you have the government expenditures in a solid shaded grey, and that's always negative, just about. And on the top, in a darker black line, is what I call the private sector surplus. And you can see this is mathematically correct, that one mirrors the other one, and that what the government spends into the economy becomes a possession of the private sector. And you can see in 2000, between roughly around the 2000 mark, the grey line goes up into positive. They were the Clinton surpluses leading into around the dot-com boom time.
Yeah.
At that time, the government was taxing so much money out of the economy that it was reducing financial balances in the private sector. And it actually caused the dot-com crash.
That's interesting. Now,
Yes.
another observation I would have is this. So this is the sort of nonsense I think about when I'm walking the dogs, right? So everything we've just been through that says, in this view of the world, basically government debt drives risk assets through the process we've just described. Then
Absolutely.
I sort of, okay, well, it can't be that nobody pays for this. It can't be that you can just invent money and everyone gets richer. It must be that there is a balancing effect somewhere. And it seems to me that inflation is the balancing effect. And we know that the creation of money, all other things being equal, leads to inflation. For the same reason it leads to rising risk asset prices. If there is a private sector surplus, then prices for stuff, gas, fuel, food, shelter, whatever it might be, it's going to rise. We also know that inflation in general is good for rich people, because if you have a surplus of assets over income, then inflation helps assets usually, all other things being equal, although it suppresses your income if you are a price taker. If you sell your labor for a living, you're a price taker, inflation bad. So it seems to me that the who is paying for all this is basically anyone who sells their labor for a living and who does not own risk assets. So it's my, again, somewhat kindergarten take on this was, okay, so the whole system of government debt issuance is bad if and only if your sole source of money is selling your labor for government created money, because you are in this sort of perennial uh, depression cycle whereby the value of a dollar or a euro or a pound or a Aussie dollar, whatever it might be, just gets less every year. It structurally gets less every year. That can't not happen. Meanwhile, anyone who owns assets is seeing those risk assets on in the aggregate, on average, go up. And so basically, this is a great method to transfer wealth from labour to capital by way of government debt creation. That's sort of my take on this.
Yeah, there's when you create money and put it into circulation, which is a sovereign privilege of the federal government, there are only really two limits, and that is, as you touched on there, that's inflation,
Mm-hmm.
which devalues the currency and people lose faith in it, and it starts getting ridiculous, like the Weimar Republic, for example, in Germany
Right.
back in the
Yep.
20s. Yeah, just
Yep.
way too much printing and so on. And the other one is a devaluation of your currency. Probably a
Right.
good modern example at the moment is Russia. You know, Russia
Mm-hmm.
has a modern, fairly advanced economy. They've got themselves involved in a war. They're printing lots of money to pay their soldiers and armaments industry. And two things have happened. They've got inflation running at about some 20%, I would imagine,
Yep.
and they also have their currencies falling against all other currencies. If you take a basket of currencies and compare it to the ruble, it's
Yep.
falling. So they've reached the point where government expenditure, government money creation, the sovereign privilege, has been over exercised.
Yep.
And you've got as you're pointing out, taking to extremes in a modern economy, you get those two factors, and they need to rein that in. And not only are they printing money, but they're doing it in a destructive way. If you were printing money, for example, and causing infrastructure or healthcare
Yep.
or
Yep.
education, productive good things to be done, you
Yep.
would probably create long-term deflation because you're making the economy more productive, the
Yep.
people more productive. That's land itself with the power and roads and water supply, all those things better. That's deflationary because you're lowering the base cost of the economy on
Yep.
which businesses and private people live. But he's doing the exact opposite. He's killing off his labour force. They're basically building things and blowing them up again and blowing
Yep.
up other people's things, and they're lowering their asset base, their capital stock. So
Yep.
it's all the things you shouldn't do is being done in Russia, and it's a great illustration of the currency creation privilege being abused and
Yep.
misused.
Terrific. Okay, that's really clear. Um, okay, and so in your own investing, what you do is you watch fiscal flows and you use that as a backdrop. I mean, obviously, it doesn't predict the S&P every day of the week, but you use that as a backdrop for, as a longer term investor, when do you put capital in harm's way and when do you take it out of harm's way? That's your method.
That's exactly right. Great big macro moves.
Yeah.
I'm not somebody that's a day trader that's watching the
Yep.
screens all day.
Yep.
I just like to invest on major peaks and troughs. And it's so nice when you buy, for example, and I usually buy index funds. I don't try and buy single name companies because they can have their own
Yep.
problems. You know, for
Yep.
example, a friend of mine did a great analysis on medical properties. It looked great on when he did his fundamental analysis, and then a few weeks later there was a scandal and found out somebody was cooking the books,
Yep.
and the and his recommended stock sank like a stone. So if I was investing in real estate, for example, I would buy an ETF for REITs or REITs, depending on how you pronounce it, real estate investment trusts, and get exposure to the whole REIT sector rather than just one company in that sector. And for that reason, when I invest, I invest in the NASDAQ as an index, the SPX as an index, and the Dow and that sort of thing.
Yeah, it's harder to cook the books for an index, that's for sure. At least you ride out some of that single company risk. Yeah, I agree. Okay.
And indexes are good because the bad companies drop out and they're replaced by better companies. It's like a self-cleaning process.
Yeah, that's a good point. I never thought of it like that, but that's a good point. Yeah, that's a good point. Alan, I'm going to throw this open to questions because I personally find this fascinating. The mind blown point for me was government credit creation, good if you're a person who owns assets and you're trying to build up your asset base. It's a completely different way of looking at life. And as Alan said, the narrative, especially at the moment, you get all day long, which is, debt bad. And the only current account surpluses I can remember in the US were the Clinton surpluses. And as you can see, they were actually destructive for risk assets. So anyone have any questions or points or comments or anything at all that you want to fire at Alan? If so, best way to do it is either open your mic. I'll switch microphones on now. Sorry, I forgot to do it before. Just do it right now. So mics are on. Alternatively, you can type them in. Right, Alan, I have a question for you here written up. Okay, so JM says, thanks, Alan, for sharing your perspective and experience with us. Given the observed weakness in the market via declining liquidity flows heading into April, why not go short versus holding capital back? And then upon reaching the next peak post-April into the next decline, why not short? Or how are you thinking about positioning the market? Thank you.
Yeah, that's absolutely correct. I'm a very conservative investor, and because I know the macro direction of the economy is upwards, and perhaps we should discuss the real estate cycle and so on.
We should definitely do that. That would be great.
Yeah, and also the strength of the fiscal flows are so strong that I'm very, very wary of shorting a very strong bull market that I know from the flows behind the market is just wrong. It just feels wrong. Now, what I may be doing, let's pull up the Fred Harrison real estate chart number 17.
Yeah, hang on.
This is the real estate cycle, and this is a chart that came out of the English papers not long ago. There's a guy in England called Fred Harrison, wrote a book called Power in the Land, where he documents the real estate cycle, and it's roughly a 20-year cycle from beginning to end, with the different phases that are marked on it. And it's been repeating pretty consistently for the last 200 years in the time that we've had a modern economy, where the land's been enclosed and sold, which is what it's all about. It's the enclosure of the land and selling it. It's the enclosure of probably our only limited resource that everybody needs and has to have for accommodation, and then selling it privately. And he's documented that it rises and peaks. And the next peak is in real estate is 2026. Then we're going to have a crash, as he's marked on the drawing. Now, what happens is the real estate market peaks in terms of sales volumes and prices, and then about a year later, the stock market starts to drop, and then GDP drops as well in that order, and they're probably years apart. But in 2026, I would be looking at selling all of my real estate, except the house I'm living in, and that's my current construction plans at the moment. And I would start looking at my investment portfolio of funds and so on, SPX and Dow and NASDAQ, very closely with a view to getting out and, as your contributor suggests, shorting the market all the way down into about 2030. At that time, the macro direction of the economy is downwards, because we've got a number of things happening. We've got a rollover in the demographics. If you go to chart number 5, This is from Hoya Capital, who's also into real estate, and you can see that the best demographics for house buying is peaking out in 26, 27, and thereafter it drops and keeps dropping right into 2035.
This is because of aging
So
population.
it's what it is mainly. Let's go to another slide, number 6. You can see if you take this chart and put the recessions over it, you'll notice the recessions are always in the dips on these lines. And what these lines are, they're dips in the population cohorts. And the most important population cohort are the people aged between 15 and 65, known as the working age population. That's the most effective one because all those people are working, earning, buying, and most importantly, they're making things for others to buy.
Yeah.
Now, what's going to happen, as you can see on this chart in 2025, which is very relevant for us now living, is that it peaks probably a little bit after 2025. You can see on this chart, the peak's probably in 2026-ish, as that Hoya chart was showing. And what's going to happen is the heat is going to go out of the real estate market very, very quickly because there will be just a sheer lack of demand for accommodation. And there's going to be such a drop in aggregate demand for all things at that time that we're going to have a recession and risk asset markets are going to drop. And this mirrors the real estate cycle that Fred discovered because the for most people, the biggest thing they're going to buy in their lifetime is their house. And suddenly that's going to drop off. Instead of rising each year, the demand for housing is going to fall. And there's so much money in the housing market by way of mortgages and credit, that sort of thing, that it has a massive impact on aggregate demand. And despite all the things that the government's going to try and do when this happens, like they did in GFC1, there's going to be TARP schemes and fiscal stimulus and all those things. There's no way that anybody can stop the population dropping or the working age population dropping in that huge sagging aggregate demand. And that's what drives markets at the base level, the fundamental level, are demographics. And that's at the time when I'll be going short.
That's great. Thanks, Alan.
To answer your question, rather long-winded.
That's a very good answer. Thank you. Any more questions, folks, or points or comments or anything else? I personally find this fascinating. I spend all my time on, in part, company fundamentals, and then in part, pattern recognition in large liquid securities. And I don't really spend very much time at all looking at the things that sit behind, both company fundamentals and price patterns. But this is the stuff, this carrier wave concept is, I think, something you increasingly should have in the back of one's mind, not to determine, am I going to buy Nvidia or sell Nvidia today? Clearly that doesn't, that's not impacted by this. But in terms of, preparing for when the market turns, you see me talk a lot in the service here about, okay, we're probably nearer the end than the start of this current bull phase. And so there's two jobs to do right now as an investor. One is don't pull out of the market too soon because there's tremendous gains to be missed. But don't believe it's going to continue forever. And you see, the work that I and the other analysts do in the service here, lots of it is focused on when is it? When's the fundamental top? Just the same as we were doing in 2021. And the same on the other end, looking at the lows in 22 and the lows in 2020. So a lot of my work and focus and attention goes into worrying about not missing the top, both not calling it too soon and not missing it. And so I love stuff like this because this gives me a slower burn backdrop for, well, when are things likely to change? This won't tell you what day the S&P will peak at, and it won't tell you what the level of the peak will be, but it gives you that slow burn context for, well, roughly when should I expect the market to turn? Because most investors don't think like this, right? They think, well, they don't think. They react according to the emotions that they have. They think are independent, but in fact are created by social media and the news and all the things we know about. People don't think like this. So if you think like this, if you think slow burn like this, and you have your finger on the pulse with price charts and fundamentals, gives you a huge edge in markets. It enables you to be calm, for one thing, because you have an idea about where things are going and why. And it also means that when a bottom comes, you can be ready to buy, and when a top comes, you can be ready to sell. So I absolutely love this work personally. So I'm absolutely delighted to have you on, Alan. Thank you. This is really, really terrific stuff. Any more questions, folks? I have one right here. Hold on. Richard, you're on.
Thanks, Alan. Oh, thanks, Alex. Yeah, I just wanted to make that connection between what we're hearing about the deportation of immigrants in the United States versus the demographics, and it just seems to be kind of a strengthening of that, potential lowering of the demographic population just at that same kind of 2026 period comes along.
Yes, that's a very good point. That actually mechanically lowers the population over and above the natural aging and retiring of people, and also behind the baby boomers is a much lower, smaller population cohort of people coming in behind them, and taking people out the economy by deporting them makes that situation even worse and accelerates it a little bit. Similarly, when we had the COVID back in the early 2020s, 500,000 Americans died, and that took a large swath of the population out as well.
I'm curious, Alan, what you make of the current. Who knows if it'll happen, but the rhetoric is of, cutting U.S. government spend, cutting U.S. Federal debt. I think, one should be, the debt will come down if the debt comes down, and the spend will come down if the spend comes down. I don't think one should assume all of the current heat and light translates into reality. But through this lens, it seems like a curious thing to want to do for a pro-market administration, because through this lens, it would say it's going to harm risk assets, it won't help matters. So
Absolutely, yeah.
yeah.
And I wish I could take Elon Musk and Donald Trump into a room and give them a quick lesson on national accounting and fiscal flows, and they would probably have an aha moment and think, oh, we can't do this, it doesn't work, because the country is not a household. The rules that apply to us as private individuals in the private sector do not apply when you're the currency sovereign. And
That's right.
it's like one of the best analogies is you could treat the federal government with its money creation power as the local water company, and it's their responsibility to put just enough water into the town so that everybody has drinking water and enough water to wash their car and water their gardens, but not too much, and definitely not too little, because you have too little, people start to obviously die of thirst and not be able to water their gardens and those sorts of things. And in the economy, you want to have just the right amount of liquidity. Maybe a little bit too much is okay, but you certainly don't want to have too little, because things literally start to dry up and decay. And that's what they're in danger of doing. They're in danger of being the water economy, being the water company that supplies the town with too little water.
Yeah.
May I just ask what is the impact though of interest rates and the bond yields and so on? Because my understanding is that that's what they're reacting to, right? They're reacting to the bond market saying that debt levels are unsustainable. So is it maybe a bit of a show? And you've said that before, I think, Alex.
Yeah. Well, what my view is, I think you can take many views of what's going on right now, but my if I sort of try and sit back and ignore the hyperbole on both sides, I think, well, I suspect this is a performative action for an audience of one, being, the government bond market, because the stated goal of the administration on the bond market is to drop the 10-year yield, and they've said that's their intent. And so my take is, if you want to generate a lot of heat and light that looks like you're cutting government spend to the benefit of the debt balance and the ability to service debt, in theory, that means that when you refinance current debt, you ought to be able to refinance it at a lower yield than now, all other things being equal. And if you do that, then the current yield on existing bonds ought to drop some level if new bonds are being issued at lower yields, you would think. So that's my sort of spreadsheet take on the current, as I say, there is but that's a bit of a guess by me because there's a whole lot of heat and light going on, and I'm trying to get a perspective on, okay, you've got completely opposite ideologies about what government spend should and should not be on each side of the aisle, okay, but over and above ideology, what's the financial logic here? And I think the financial logic may be, as you say, Richard, to pacify the bond market. But the bond market, I presume, Alan, understands the argument you just made. The bond market will understand that, as you say, just maybe a touch too much liquidity is probably a good thing. So, yeah, I don't know what your take is on that. It's a very good question, Richard. Thank you.
Yeah, mechanically, the interest rates are set by the Fed, the FOMC at their meetings, and I've actually got a chart for that. It's chart number 11. And you can see there the solid blue line is the effective rate and it's rolling over and going down. The rates are actually coming down by themselves, and so is the CPI and so on, simply because it was caused. Back in the early 20s with COVID, we had two things. We had a very big supply side shock, which alone would have been enough to cause inflation that we got because there was just a lack of things to buy. Then on top of that, we had the income support by various governments across the world that wouldn't allow their citizens to starve in their homes because they had no income to buy food with, which was also the right thing to do. So we had a supply side shock and a demand side shock, and that caused the spike in inflation that we had. And both of those things are gone now. And because this is wave motion theory, and these waves have a very long wavelength, it's coming down now and it's unstoppable. And would you believe that the higher rates that we have now, I mean, the Fed thinks that by raising the cost of credit, it dampens the demand for credit and causes the economy to slow. That's their theory. What it actually does, when you increase the interest rate, the base interest rate, the bench rate, it actually lifts the price of credit and makes everything in the economy that involves credit, and there is a portion of credit in just about everything we do, every good and service, especially housing, it actually increases the inflation, or causes it to stay high, and becomes and with energy and so on, it becomes a contributing factor. And and they could put down. The thing is with
I'm just going to interrupt, Alan, and just give you just if that's not obvious, folks. Let me give you a perfect example of this. Okay, let's say this is my background, leverage buyouts. Let's say that collectively here between us, we own a leveraged software company. Let's say, and let's say we have to refinance our loans in 2023, and our loans go from 1% over base to 3% over base, and oh, by the way, base went up from 1% to 4%, let's say. So let's say that our debt service costs have doubled or tripled, and let's say we're 7 times levered or 8 times levered. Well, guess what? The first thing we're going to do is, okay, we're going to put up the cost of our prices, okay, because we've got, if we're an enterprise software company, we've got a bunch of captive customers that probably can't leave us anytime soon, so we're going to jam prices up. Why are we going to jam prices up? Because that's free cash flow, has no cost associated with it beyond a few emails and dealing with grumpy customers, and that's how we're going to solve for our debt service problem. So absolutely, anything that involves material credit or leverage, that's right. If you whack up the cost of leverage, you're going to force those companies to pass on the price of credit to their customers, which is an inflationary thing itself. Absolutely.
Yeah, and what's going to happen? What's going to happen in the near future when we get to the crisis that's coming up? The crash that's coming up in after 2026. and you can see that on the grey bars on this chart. When you get to a crisis, and it's the same pattern, it's the rolling over of the FFR, the federal funds rate, and shortly after there comes the recession. And they caused in some ways the recession by making the price of credit so high, and they're making so many things unprofitable, as you mentioned there with your large buyouts. But the process is baked in, and what they do once the recession gets very, very close and their indicators of unemployment and business closures and bankruptcies start to turn red and bleep, they drop the rate, and as they did last time in the GFC, they'll drop the rate, and also during COVID, back to the zero bound. And then suddenly your inflation drops, as you can see on this chart, because a lot of it was driven by the FFR itself anyway. But they fail to see that. If you want a low 10-year bond, then drop the FFR. It's mechanical, and it's not market driven. The FFR. It's a number of people, these central bank chairs who sit around. They've all got their economics backwards, and they're all believing household myths like the federal government's going to go bankrupt and that sort of thing, and they're making their decisions based on those factors. And until that stops, we're doomed to this boom and bust cycle, which we as investors can take advantage of.
There was a UK Prime Minister in 2008, Gordon Brown, who was an economist. He didn't last very long as Prime Minister, but he famously declared two things. When they made the Bank of England independent of government in the, I'm going to say 97, 98, around that time, he declared it was the end of boom and bust. Then when they did a series of bank bailouts in the UK, a sort of mini version of all the TARP stuff that happened in the US, he declared that they'd saved the world. So that just shows what economists know. I have another question for you, Alan. We're going to run out of time soon, which is, how do you feel about government bonds? And I say this because I personally have sort of started to accumulate a position in the TLT, ETF, and why? Because I do think that we're going to see the federal funds rate drop. I don't know if it's going to go all the way down to zero, but I do think it's going to drop. I expect yields to come down as a result. I don't expect bonds to come up. And I would also expect that if we do hit any sort of crisis in equities anytime soon, be that next year, the year after, whenever, I would expect some flight of capital into government bonds. US government bonds. You have a view on that?
Yeah, absolutely. I'll be a buyer of government bonds as we go over the top into the crisis. Once I see GDP roll over, unemployment going up, the housing market is stalled, all those sorts of things, I will be a buyer of government bonds, because what's going to happen if you buy government bonds sort of nowish with, say, 5% yield, in the secondary market, when the FFR, the bench rate, is dropped to 1 or 0 bound, as they did in Europe and that sort of thing, the value, the face value of your bond will probably double, and you'll also, because the new bonds that will be coming out after the Fed has put its I keep wanting to say lights-ins, which is the German word. Once they put the FFR down, and the new bonds are coming out at 1% or 0.5%, as they were for 10 years between the GFC and 2020, those bonds coming out at 100 will make your bonds that you're holding on it from the secondary market worth probably 200. You'll make a huge capital gain, and you'll have a nice 5% return when others are getting a 1% return.
Yeah.
It's a great safe haven asset to have as well.
Yeah, I mean, I could be wrong on this, but I've started. So the huge winner for me, the biggest winner for me in the last couple of years has been I started buying levered Nasdaq ETFs in 2022, and I started a bit too soon, in truth, and had a few unpleasant weeks. But I kept going because I figured the bottom would come in not too long after I started, and it did. So August to October wasn't very much fun, but after 22, but after that it's worked out really well, and I've just added to that on the way up, and it's been a terrific performer for me. So my single biggest position by far is is TQQQ, which is, as you know, is the levered Nasdaq long. And I've started building up in TLT and TMF, which is the 3 times levered TLT, for that reason, which is I figure, okay, I think bonds are going to rise. I think now is, it's maybe not, maybe it's a bit early, I don't know, but it feels like a nice time to accumulate. And I sort of feel like, okay, TLT might behave a bit like QQQ did over the last couple of years, and TMF a bit like TQQQ. And again, I'm not sure that that's, I'm not sure it's a very popular thing to be buying yet. At least in public, if you look at the volumes traded in TLT and in TMF down here at the lows, it's pretty substantial. It looks like institutions have been accumulating for the last, I'm going to say 6-9 months, something like that. So I feel good about that trade. We'll see, but I feel like that's a nice place to start building up at the moment, and hopefully reap the benefits in the next couple of years.
Yeah, if we go back to slide 17, you can see we are at the moment we're in what Fred has labelled the explosive phase.
Yeah.
And that's when the market goes absolutely crazy. You get people like Gordon Brown saying it's the end of boom bust and all that sort of thing. And they basically call the top of the market because they've said something very silly which isn't true, and of course the reverse happens shortly afterwards. That was a great point to bring up.
Yeah.
But at the moment we're in the beginning of, and we've still got a good, I reckon, 18 months, perhaps 2 years of super bull markets in the stock market.
Yeah.
And I would be buying SPX, Dow, Nasdaq, that sort of thing.
Yeah.
And I would only be buying American index funds, because when I look at all the other countries that I analyse, they either have sinking populations, which at the very base level undermines their markets, or they've got very, very austere governments, like in the UK, which simply aren't providing the town with enough water, so the risk asset markets can't grow. And
yeah, that's right. I mean, actually, it's a good piece of supporting data for your theory, by the way, is in the GFC, the UK government did in my opinion, the 180-degree wrong thing, which is they choked all the water off. They went, okay, well, everything's broken, so we're going to cut back on spending. We're going to try and get some sense back into government financials. So we're going to cut benefits. We're going to cut infrastructure projects. We're going to cut, fiscal, so everything. Cut everything. And the country was instantly poorer and has stayed poorer, not helped by Brexit and other things, but has stayed poor since 08, 09, when the US, for example, has just got colossally richer because they did the opposite. They flooded the market with liquidity to pretty much everybody's benefit. The rich, of course, are benefiting more than the poor. That's normal, but pretty much to everybody's benefit. Whereas when the government as a household theory was applied in the UK in 08 and 09, it's just a disaster, and they've stayed that way.
Absolutely. The UK is almost a poster child for what you shouldn't be doing to run an economy, a modern developed economy.
That's exactly right.
They're doing exactly what you shouldn't do.
That's exactly right.
And they're reaping the grim harvest for it.
Yeah, absolutely. Well, on that happy note, and I agree with you on that, by the way, look, we're out of time. So thank you so much, Alan, for coming to talk to us. I find this, as I say, a super, super, super refreshing perspective. The first time you come across this thesis, folks, it's a bit like, that can't be. And you go back to sort of, high school economics 101. But if you actually study the data, and you free your mind as regards this in the same way that you have to free your mind with risk asset prices versus earnings and the news and all that stuff that we talk about all the time, data supports the theory. And so that always tells me that one is on the right track. So again, no investing method is perfect, no analytical tool is perfect, but I think this is a terrific additional set of tools in the toolkit through which to see things in a slightly longer term and to get ready for when tops may come and when bottoms may come. And so I'd encourage everybody to seek out Alan's work. I'll post a couple of links in our services where you can find his stuff. And he writes a fairly long article each month analysing US government liquidity in the past, in the prior month, and where he thinks risk asset pricing will go in the current month. I don't miss it. I really, every month, the day it comes out is terrific, and I would encourage you to do the same. So, Alan, thanks again. Folks, if you think of any questions after the session here, just post them in chat and we'll get them across to Alan. I'll get the answers back for you. But in the meantime, thanks everyone for joining. And Alan, thanks again for coming to talk to us.
Very welcome.
Okay, folks, see you all later in chat. Thanks again.